Here we are. We are on Chapter 3, and this is the final lesson for this week. And this should be review for most of you. We're going to look at financial statements and cash flow. And what we're going to talk about are computing a company's profits. We're going to look at their financial position in a point in time. We're going to look at how a company measures cash flow with a cash flow statement. And then we'll look at how they compute their taxable income and how they pay the taxes. So this is kind of a review of Accounting 272 or any Accounting 101 class, but it may have been a couple of years since you've had that. So we're going to review two parts. First part is going to be about some of the principles we apply, the key terms in the balance sheet. Second part is going to be about the income statement and the cash flow, and then we'll add the taxable income onto that. So here we go. As before, we're always going to go back to those principles that we looked at in the first chapter, and the two principles, finance principles, addressed in this chapter are cash flow is what matters, and the other one is conflict of interest caused by agency problems. And that deals with manipulating accounting data and giving better reports than are actually true. So, let's get started. Let's look at the key terms. Now, key terms are 2 pages of them in this in this chapter, and they were kind of all messed up, so I put them together. First part of this right here are going to be just accounting terms. Accrual accounting, the balance sheet, common size, financial statements, debt ratio, cash flow statement, income statement should be on here. Just a hodgepodge of general accounting terms. Over here I have all of the balance sheet accounts listed that they've talked about here. On the next page we've got even more. So here's some more balance sheet accounts all the way down to right here. Well, this one goes over there. But these are all balance sheet accounts, and they should sound fairly familiar to you. On this side we're looking at income statement accounts and things that you have encountered. So these are the terms that probably will be very, very beneficial if you have some bit of knowledge of them for the quizzes we're going to be doing, and simply to be able to talk with people in finance about accounting. So the first thing they look at in this chapter is the income statement. And of course that's also known as a profit-loss statement. And it measures a company's operations or its performance through a specific period of time, like from January 1 to December 31st of one year. And the bottom line is always profits, right? And that involves sales minus expenses, and that gives us profit or revenues. So sales and revenues are a bit synonymous together. It depends on which segment of industry you're working with, what they call it. So let's get on to, here's some statement or some income terms, income statement terms. Again, here's revenue and sales. Okay, you have cost of goods sold, and that is only that's found in merchandising and manufacturing. If you're looking at a service-based business, you won't find the cost of goods sold because they don't sell goods, they sell a service. And these are listed in the order that they appear on the income statement. So first you have the revenues, then you have your cost of goods sold, then you have operating expenses, then we look at the financing cost, okay, the interest that we pay to creditors, and finally we take out the tax expenses. And that will give us the bottom line. This, as I said, this is mainly review, but it's good review. This shows it again, sales minus cost of goods sold equals gross profit, or the gross margin it's sometimes called. Then you subtract the operating expenses, and that gives you operating income. Next up, you will subtract the interest expense. Okay, these are your financing activities, and that gives you earnings before taxes. Then you will subtract the income tax expense that you have to pay, and that will give you net income. So you're shooting for that earnings before taxes so you can do your income tax. And this is the way a typical income statement looks. You can see there's the sales, the cost of goods sold. Come down, here's your operating income. Here's your debt finance. Here's your earnings before taxes. Then your income tax is figured in. And finally, right here, you've got your net income. And this one also has your dividends paid to the stockholders of $10 and the number of shares you have out. And then it goes further to show earnings per share, which is $2.10, which is 42 divided by the number of shares. And the dividends per share would be the dividend payout divided by the shares. So typically this is an income statement you would see from any business. You should be able to read these. It's very important. The other thing that this chapter brings up are common size income statements, and they restate all of the numbers, all of the dollars in percentages of sales. And that becomes very handy so that the size of the numbers you're using does not distract in between looking at operations or looking at different businesses, their income statements. And this looks something like this. Here's a common size. Here's our sales. Our cost of goods sold is 76%. Our operating expenses are 10%. Now you can take this and compare across companies now without having the numbers get in the way. So that becomes your income statement, and I think I have enough time to do the balance sheet too on this one. So now let's look at the balance sheet. Balance sheet is a little bit different. It is only looking at a company at a particular date. So remember, all of those balances in those accounts that we put on that balance sheet can change in a day's time. And this is where we come up with assets equal liabilities plus equity. You probably remember that from your previous classes. So we take the transactions in the balance sheet and record everything at historic cost. So there's a book value of the firm, and that book value may be different than the current market value. So there's a transition. You have to look at both. And this is kind of how this plays out. The income statement and the balance sheet are intricately tied together. The income statement reports the profits from January 1st to December 31st. The balance sheet will report the company from that date, January 1st, to the balance sheet date, December 31st in 2010. Now, what the operations that transpires in between here is what is measured by the income statement. So this is all braided together and intertwined. You can't, in fact, the order of doing the financial statements is that you have to do the income statement to find the income. Then you have to do the retained earnings or the owner's equity to find the owner's equity, the change, and then you can do the balance sheet for the end of the period. So they are braided together. So now these are the terms for a balance sheet. We have the assets. Those come in current assets or non-current asset or long-term assets or fixed assets. The current assets are the assets like cash, accounts receivable, inventory, other assets that are going to be used up readily within the next 3 to 5 months or within a year's time. Those are current assets. And we move on and we get to fixed assets, and these are assets we're going to use for more than a year. And they're typically machines, buildings, land, called property, equipment, and buildings, so that you can keep. So you've got property, you've got buildings, and you have equipment that you're going to keep track of. Then there are other assets that you could be keeping track of, long-term investments, intangibles, things of that nature. But that's what shows up on the balance sheet on the asset side. Then you have liabilities. Remember that equation, assets equal liabilities plus owner's equity. So then you'll have debts, you'll have current debt, and you'll have long-term debt. Current debts, again, are the accounts payable, the accrued expenses, short-term. Long-term are things over a year. And finally, we get to the equity, which shows how much the shareholders have invested. It will show the treasury stock and the retained earnings. As you put this all together, you will find that total assets will always equal total liabilities and equity. And this is what a general balance sheet looks like. Assets equal liabilities plus owner's equity. And the accounts that make that up. Again, here's a look at a comparison income statement, 2009, 10, and then the change, so that you can see any changes between the two. Puppy dogs are barking here. And we'll come down, and there are a couple of measurements we get off of our income, our balance sheet, and that's our net working capital, which is very important. You have to be very careful with net working capital. More is not always better. And usually you look at net working capital to see how efficiently the company is managing short-term assets. If you have more working capital in-house than you need, that means you're not efficiently and effectively investing the resources of the business. You only want to have enough working capital on hand to pay the required liabilities at the time. So that's a real fine line. You have a debt ratio that you're going to look at to see what percentage of assets are financed by debt. You want to make sure most companies want to have a fairly low debt-to-asset ratio. By low, I mean the debt side being low. And it kind of indicates financial risk. Usually higher the ratio, the more risky the firm is. So you have to be very careful because you don't want to put out the impression that the company is financially risky, because then when you go to borrow money, as we discovered in Chapter 2, the higher the risk, the higher the interest rate, which means you would pay more for any money that you borrowed. And that kind of wraps up what we're doing with the balance sheet. The next thing we're going to look at is measuring cash flows. And that's going to involve the statement of cash flows. So hang in there. Stay tuned for the next one. Thank you.